Ladies and gentlemen, good day and welcome to DLF Limited Q1FY23 earnings conference call. We have with us today on the call Mr. Ashok Tyagi, CEO and whole-time director, Mr. Vivekanand, Group CFO, Mr. Akash Ori, Chief Business Officer and Group Executive Director, Mr. Sriram Khattar, Managing Director, Rental Business. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vivek Anand. Thank you and over to you, Mr. Anand.
Thank you and good morning to all of you and welcome to DLF Limited Q1 Financial Year 23 earnings webcast. Thank you once again for joining us today. Hope you and your family are keeping well and safe. Our business continues to deliver consistent performance across all parameters. I'll start with the financial highlights for Q1 Financial Year 23, which is for DLF Limited consolidated results. Consolidated revenue stood at rupees 1,516 crores, reflecting a year-on-year increase of 22%. Gross margins continue to operate in the 50% plus range. Q1 margins stood at 53%. EBITDA stood at rupees 488 crores. There is a drop in this quarter as the business is in scaling up phase and investing for growth. The increase in staff cost is driven by organization scale-up and other expenses driven by business scale-up cost of marketing and brokerage. We follow a policy of fully charging of sales and construction overheads, for which the corresponding revenue will be recognized in future. Net profit at rupees 470 crores, reflecting year-on-year increase of 39%. This was largely driven by significant reduction in the finance cost, along with growth in the JV profits. Residential demand continues to exhibit sustained momentum. The high demand for luxury homes has been a key trend that is expected to continue. Our residential business continues its steady performance and clocked new sales booking of 2,040 crores, reflecting a year-on-year growth of 101%. The Camellias, our super luxury offerings, continue to remain the preferred destination across the super luxury segment and delivered a healthy sales booking of rupees 350 crores during the quarter. Our new products offerings continue to evince strong interest from the market and made a healthy contribution of rupees 1,532 crores during the quarter. The contribution of new products in the total sales was approximately 75%. While rising interest rates may pose some challenges, we expect this structural recovery in the residential segment to continue. We continue to bring newer offerings across multiple segments and geographies. We continue to remain committed towards surplus cash generation from our operations. Continues to be a focus area. We generated surplus cash of rupees 421 crores during the quarter, which led to further deleveraging, and consequently our net debt at the end of the quarter stood at rupees 2,259 crores, one of the lowest levels. I will now move to the financial highlights for Q1 Financial Year 23, DLF Cyber City Developers Limited consolidated results. We witnessed steady performance across our office portfolio. Retail business continued its growth path and delivered a healthy growth. Rental income grew 20% year-on-year, driven by a strong growth in retail revenue. Consolidated revenue of rupees 1,260 crores as compared to rupees 1,041 crores last year, reflecting a 21% year-on-year growth. EBITDA at rupees 961 crores, year-on-year growth of 18. And net profit at rupees 323 crores, reflecting a year-on-year growth of 60%. Occupiers' attendance continues to exhibit steady improvement, indicating return to normalcy in the office segment. Our Chennai asset is witnessing approximately 80% attendance compared to pre-COVID levels, and Cyber City Gurugram is seeing 50% attendance. We are witnessing month-on-month improvement in these trends. With sustained collections and steady improvement in occupancy, the office segment is well poised for growth. We continue to deploy capital for creating safe, sustainable, and quality workspaces. Development of our new destinations across multiple geographies remain on track. Retail business continues to exhibit steady growth with improvement in consumption trends. Organized retail is expected to gain further share with strong preference for quality assets at established locations. Given these tailwinds, we remain committed to grow our portfolio across multiple geographies and hope to double our retail presence in the next few years. Our strong balance sheet, healthy cash flow generation, coupled with a diversified pipeline of quality offerings, provide us a unique opportunity to leverage this upcycle. We remain committed and confident in delivering our business goals. Right? Thank you very much. We now open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. To ask a question, please click on the raise hand icon available on the toolbar, or you may click on Q&A icon to raise hand or type your question. Participants connected to dial-in may press star and 1. The operator will announce your name when it is your turn to ask a question. Please accept the prompt on your screen and unmute your microphone while proceeding with your questions. We will wait for a moment while the question queue assembles. The first question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Hi, thank you, gents, and good to see you on a Saturday afternoon. Sir, I had a few questions. One is effectively on this gross margin. So, your gross margins at 50% plus are the best in the industry, but when we compare you on EBITDA, the number is, you are lower than the industry. So, and I know that you have increased your staff and other expenses, but is there like a target level of margins you want to run at? I mean, should we expect a 35, 38% ballpark EBITDA at DLF, or how should we think about the EBITDA level? The second, for Akash is, so we have seen price increases, Akash, in Crest. Feedback is that price has gone to 25 to 30,000 in the market. So is there any early feedback you have for your golf course extension project? Because Gurgaon finally seems to be going up in prices. When do you expect to launch it? And what is any early indication on that? That plus Rees Magos. And the third is on this 900 crores of capex in the parent business, the rental for this will be about what, 200 odd crores? And which specific projects are these? So that's it from my side. Thank you, sir.
So thank you. I'll take the first question. Thank you, Saurabh, for your question. So let me take the question on the EBITDA. So first of all, as I outlined, that we are in a business scaling up phase, and we are investing for growth, right? So as you know that there will always be a delta between the time you scale up and the time you actually recognize the revenue, right? Having said that, if you really look at current quarter margin, we are holding on to our margins at upwards of 50%. To be precise, this quarter, our margin delivery was 53%, right? We are also committed to really bringing in new products, which will continue to enhance our margins, right? So I'll just give you an example that the DLF city floors, what we've really launched in the last 18 months. So there is 3,000 crores of city floors, what we've launched. They are all adding up to a margin of 55% plus, right? And overall, the new product portfolio, what we've added in the last 18 months are committed to really enhance our margins as we go forward, right? And yes, EBITDA last year, if you really look at our EBITDA margin was 35%. Yes, there has been a slight drop, but I will say that you should not be really looking at our P&L on a quarter-on-quarter basis. I think directionally, if you really look at, we are investing for growth. So yes, there is a time lag, right? But I think if you really look at long term, I think the product offerings, what we are really bringing in, they are all margin accretive. And with time, when they start recognizing the revenue, you will see that the EBITDA levels will start inching upwards of 35%.
Yeah. So basically, Saurabh, I mean, just to elaborate on what Vivek said, I mean, really at 35% is definitely on the horizon. I don't think that's a challenge. It's an issue that basically right now, because if you look at our absolute margin is 750 odd crores, which on the current run rate will be a number closer to 1,000 on a go forward basis. So I think once this lag between the revenue and costs corrects, I think as Vivek mentioned, I think a 35% plus margin should definitely be doable yet again. So
thanks, Saurabh. So yeah, you mentioned about Crest price points as you're right in where they are today, but that's also a function of a lot of other things that go behind. So not every property there, if you noticed also in Gurgaon, is today demanding that kind of a price point. But also there's a lot of work that goes behind it, and therefore we are committed to continue to make sure that post sales our service levels and deliveries are at par with what we had committed. So that is also a function of making sure that the price points are stable and sustainable. So these are all second and third transactions in the market. So I'm glad you mentioned it. As far as launches are concerned, yes, we are working on as we had also presented earlier. So the all the products that you mentioned are being worked on, and yes, there is a visibility of launches this year. And we're looking forward to it in Q3 and Q4. We are ramping up, gearing up. Just to let you all know that today we are happy to mention that most of the international designers in the world today are aware of DLF, are aware of what products and the quality of products that we kind of churn out, and are spending their time and pitching for our products. And this is across the board I'm talking about. So we work with most of them. We're hiring a lot of them. So that particular thing is also going on. And as far as Goa 63 and other uh, floors that Vivek also touched upon. So for us right now, how we are looking at quarter on quarter is obviously the residual stock of super luxury, which is now minimal, but we want to continue to make sure that those price points are there where they are, and we sell them. We continue to focus on our floors, which is by now I can also tell you that is it's been accepted, and there was a major gap in the unorganized market, I think, which we've gone and plugged. So the DLF floors today are not only accepted but are traded. And then, of course, there are the group housing launches that you mentioned, and of course, Goa as well. So we're on. Thank you.
the CapEx.
Yeah,
Thank-
CapEx on the new products are split them into two. One which are in the books of the DCCDL platform. There we will continue to invest about between 12 to 1500 crores over the next 3, 4, 5 years. And this includes DLF downtown Gurgaon, DLF downtown in Chennai, the Mall of India in Gurgaon, the Vasant Kunj mall expansion, etc., etc. In addition to that, there are a few projects both in offices and retail in the DLF on the DLF platform, which include the IT park in Noida, the new mall which in Goa, which we are now named as DLF Avenue Goa, and the high street shopping centers in phase 5 in Gurgaon and near Midtown. This, I think, would entail an expenditure of about 500 odd crores, 4 to 500 crores a year.
For a couple of years. I think totally
For
about
the next-
800 crores now.
Yeah.
Thank you, sir. I have a few questions on the margin, but I'll come back later in the queue. Thank you.
Sorry?
Thank you.
Thank you. The next question is from the line of Murtaza Arsiwala from Kotak Securities. Please go ahead.
Continue. Hi, Akash. Question for you. You've had a successful 18 months with the new product launches, etc. And about a year and a half ago, you did carve out this 35 million square feet. Any chances? I'm sure you must be working on it, but any communication you want to give on how you want to replenish that 35 million, given you've been 1.5 years at it, replenish that launch pipeline, taking in more from the land bank?
So, Murtaza, thanks. Good question. So, with regard to launches and how we have kind of mobilized markets, I'm glad you mentioned those 18 months because we've been talking like this. But if you see how we have gone into every market and quietly, like I'll make a small point of Chennai. We were there about a decade back. We got in. We worked against all odds. Outsider company, North Indian, whatever, national. Yet I think the brand DLF prevailed. We got the maximum press. We got the maximum traction, and I can't thank enough our investors. So what happened there was that we have land banks, as you all know, across the country. Today, what hopefully we are demonstrating to you and to the organization is that every square inch of our land bank is monetizable as and when we bring them in, and to the levels that we can actually deliver are the price points. If you see Chennai, we did above almost 40% over what the actual markets there are. You look at Panchkula and Tri-City. At one point in time, I still remember 3 years back, it was completely written off. Today, our price points are again setting benchmarks in the market for others to follow. There is demand. Two major product launches are slated there. So basically, what I'm saying is one step at a time. What we are carefully and consciously doing is that wherever we go, looking at those markets, looking at responses. If you look at Indore and Lucknow, we completely cleaned it up. Kochi, we've just got this one Whitela to go, but we've got another land bank. So everywhere where we are seeing buoyancy, we are seeing the DLF pull, and those areas we are now. In fact, I can't single out even one geography and say that look, that's not accepting us or that's not. Every geography is wholeheartedly kind of gone and endorsed us. So I think you will see, but I just want to be cautious here. All I'm saying is that we go by what the business plan that we have given you all. But today, I think there is confidence even within our systems that we will not only move at lightning speed, but also can deliver irrespective of whatever the conditions are. And I think that is important to know. So yes, to replenish, we've got enough. So every zone, like Chennai, we've done one. We're already talking about two more. So all that will now continue to happen. Panchkula, we did whatever residual about a year and a half back. Today, all our launches, as you know, are all new. So everywhere where we are, other than Gurgaon, I'm saying, which is our hub, wherever we are going, we are making sure that first we get the kind of, first we seed the market, we do our conversations, and then we are on. So we will continue to replenish as we go along.
And Murtaza, but just to sort of reinforce what Akash said, we are doing all of this across India. But make no mistake, our predominant area of focus remains NCR and Gurgaon, and we already have lined up, and which we communicated when we met all of you a few weeks back, the launches that we have in the pipeline here. And I think you'll continue to see a series of new products coming in not only in the next 18 months, but beyond that as well.
Thank you. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Mohit Agarwal from IIFL. Please go ahead.
Yeah, thanks for the opportunity. My first question is, Akash just wanted to clarify, did you mention that you are looking at a phase 5 launch in the second half? Can you just clarify that?
No, Mohit, not phase 5. DLF 5 launch is not second half. That is other projects further down. So not DLF 5. DLF 5 right now. Yeah. So DLF 5, we are doing a very premium launch, which is called the Grove, which are the gold standard of floors, if I can call them. And I strongly recommend a lot of you and everybody else to invest, because that's the last parcel of, I'd say, plotted development ever that you will see in one of the most premium geographies of the country. So that is something that we will be launching in the next quarter for sure. But if you're referring to group housing, that's a little further away. But I think this is going to be a very price catch for whoever can get in. Mohit?
Okay, and how big will that be in terms of million square feet?
सेल वैल्यू मैं आपको बता देता हूँ. So that is going to be around almost 1700 to about 2000 odd crores, and that is something which is there, yeah, but it's going to be very exclusive,
And
very premium, very private.
sure. And what are the timelines for a Crest II launch? What are your thoughts on that?
Crest 2 will happen soon. Will happen as we go along. As Saurabh just mentioned, thankfully you all are now talking about these price points, and I am not. So I think market has endorsed them. Overall infrastructure also plays a huge role, and then the community. I think what I always believe, that what makes places and companies are its people. So this community that DLF5 has today created is very aspirational, very thing. So I think you will hear from us, but I don't see it happening in this financial year, to be honest with you, because it'll require, that's going to be a big kind of a mammoth job, and it will require that much of detailing and preparation. So not this financial year, Mohit, but look forward to it.
Sure. Coming to, we've done 2,000 crores of pre-sales this quarter. Now, first quarter, as you know, is typically not the strongest for residential. A couple of months back in the analyst meet, you had given a guidance of about 8,000 crores. So how do you look at that, considering that we have a strong launch pipeline? Do you want to revise that 8,000 crore number, considering we've done 4,000 in the first quarter itself?
No,
2,000 in the first quarter, sorry.
We won't revise anything for now. We will continue to give, stay to our guidance. But as you rightly said, yes, in fact, just before the call, I was sharing this data with my colleagues of the last 5 years quarter one performance. So yes, this is definitely very encouraging. But again, we're not getting carried away with anything. There's also headwinds, with everything else going in the future with interest rates and all that. So even we'd like to keep the buoyancy on, but still, I think there's always this lurking fear. So be always grounded about these things. I think we've got some launches going on. We've got certain things coming. So Q2, I think we'll focus on right now what we have, and we will keep the guidance as is.
Okay. And my last question is on your cash flows. So, see, the collections have been at about 1,000 crores, whereas the pre-sales number has moved up from about last 4 quarters. So when do we see that catch up happening, in terms of when do we see the collections moving up to the next level? Also, the overheads have been elevated for last 2 quarters. So in the cash flow. So is that the new normal on the overheads?
Yeah. Hi, Mohit. So your first question is on the collections. So the collections for this quarter, to be precise, is around 1,000 crores, right? And we expect, as we scale up, this collection number to really move up, right? So I think in the last call, I had mentioned that last year we made a total collection of 4,400 crores, and we are committed to really scaling up on that in line with the sales growth. So I think that is something we are committed. So answering your question, you will see the collections picking up starting this quarter, right? And on the fixed cost, yes, you are right. There has been the numbers have really moved up in the last 2 quarters, and that's what I explained, right? The way to really look at is that we are investing for growth, and as we are scaling up our business, we need to really do that. And what is important to really see is that where are we really adding this cost? We are adding in supply organization, and we are adding it in sales organization, which is really helping us really grow the business, right? In terms of, if you remember last year, we had indicated that when we had given a sales guidance of 4,000 crore, we had said that our fixed cost will be in the range of 550 to 575 crores. And now, since we are really scaling up, we are almost doubling our business, right? We expect this to really move up, right? So we expect this cost to really move up close to 675 crores on an annualized basis.
Okay. Okay. Thanks a lot. I have some more questions. I'll come back in the queue.
Sure.
Thank you. The next question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Hi, thanks for taking my question. So firstly, again, on the collections, specifically in Midtown, when do we expect collections from Midtown ramping up? Because I think we are at already 2,500 crore of sales that we have done, and it's still left with 2,200 crore of collections. So roughly 10% we have collected. What's the trajectory on that?
So, see, all new projects that we have launched, whether it's Midtown or OMR, I won't say that these are new geographies for us, but they're new challenges. Also, we've got back to them almost after a decade in both these. So, logistics on ground, a lot of things had changed. We had a stupendous kind of a sale thing, and everything else, was a catch up. And then, as far as these things are concerned, I'll just quickly, I must digress and give you a thing. The adjacent properties are now almost at abutting one Midtown, almost 26 to 30,000 rupees a square foot, phase 3 of Capital Green, which was hovering around about almost 15,000 just about 15 months back, and now this is what it is. So I see that ramping up now. We had certain logistic issues and all. Also, the scale of the business that came in kind of was pretty large, and the authorities were, there were certain things that even agencies weren't formed. I'm talking about the external ones. When you collect those 10% today with RERA and all, you have those registries to be done. So all of that, I'm talking about the external support systems that kind of had to be ramped up in both these zones. I think that took time. So therefore, the call could only happen once all these things are lined up. Though we had budgeted for certain delays, but we hadn't budgeted for this kind of thing because there were completely new agencies involved. So you will see that now ramping up and going on. And as these things are, if you've seen the even both these projects, they launched at a certain price and they're kind of trading at a certain price today, and they're both very healthy in terms of these transactions. But I think I don't want to speculate there. But right now, you will see that getting better quarter after quarter.
And just to add to what Akash said, see, since this payment plan is linked to construction, and as the construction progresses, right, we are expecting a major milestone to be achieved in October. So coming specifically to your question, you will see collection ramp up starting quarter 3.
Yep. Got it. And you've made a interesting comment on slide 12. That is on industry supply ramping up. The first point on slide 12, new supply picking up. So can you elaborate on that, and I mean what sort of supply that is coming into market, and is there any impact in our plans or our pricing strategy from here on?
Basically, asking demand continues to be growing, new supply picking up in the
Yeah. So overall industry, I see, as I said, in the previous question also, I said we as an organization, I think we continue to be cautious about our approach. We always have. There is demand. See, the only thing that we will continue to give our guidance on one thing are the margins. And we, even if there is a compromise on velocity, I think margins can't be compromised at all. So therefore, it's like a chicken and egg always. So the industry products launches, if you see our performance over the last 6 quarters, it has been evenly distributed with new launches, whether it is a 1 crore product or whether it is a 30-40 crore product. We have been continuously demonstrating our sales performance and collections across the board, across geographies, across product lines and price. So here, I feel that there will be, you will see new products, but in the same line. And there is, as far as DLF is concerned, today we can safely say to you that we have a product for everybody at almost everybody's price point, because I think at that level of aspiration we'll be able to meet. But uh, what we have mentioned in the next 3 quarters to go, I think we will stick to that right now. There are no new products other than what we've already mentioned are going to come in. But that's enough. We've got group housing, we've got floors, we've got commercial, we've got a very healthy and
Competition.
yeah. So also the other supply, I feel that markets have to be competitive. People, when you put things in perspective, only then your values are also seen and appreciated. So yes, there will be other supply coming in, and I hope they come in both in Delhi and elsewhere. I think what one thing I can definitely say is, let's say Saurabh mentioned 63. As soon as we announced or even started work there and got our papers done, there are 3 projects already announced to launch. So obviously it's good, because then there are certain price points established, the demand we know. But yes, Delhi also, you will see industry launches, you will see here, but that only helps us grow. I think the markets are getting back to now happily putting their money back into real estate, and which all of us want. So the larger that pool is, the better it is. So I think overall, I'm also hearing more launches and all. So it's good. I mean, uh, there's enough space in this country for real estate for everybody.
Yeah.
Thank you.
Got it. Thanks. And one last question for Mr. Khattar. So where are we at? Our plans on the retail expansion. I'm just pointing it out from the perspective of when do you think that it will get reflected in our slide 27 table about under construction portfolio for retail.
Yeah. So under construction, let me split it into two platforms. One is the DCCDL platform, one is the DLF platform. In the DCCDL platform, our plan for Mall of India, Gurgaon, with the international architects, which is Carlson's Articare, are at a fairly advanced stage, and I think in another or 3 months we should be able to more or less finalize the plans. That 3 may go to 4 or 5 months, but please appreciate that this is going to be the largest mall in the country, and we are going to bring the best experience that one can have, and therefore the planning is taking much more, and then execution will be relatively faster. The expansion of the Vasant Kunj malls is also under an advanced stage of planning, and we should close it over the next 2 quarters. On the DLF platform, the construction of what we earlier used to call Pato Plaza, which is now DLF Avenue in Goa, is moving full scale. And at the same time, the High Street Shopping Center, which is Summit Plaza in DLF 5, is also moving. We expect both of them to be in the market by mid to later part of calendar 24. And the High Street Shopping Center near Midtown we should start construction in the next 2 to 3 months.
Got it. Thanks. That's it from my side, and all the best. Yeah.
Thank you.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Hi, thank you very much, and good morning to everyone. So, on your 7.6 million square feet new launch plan for this year, I'm a little confused. How much has been done in Q1, and how much, and what would be the sort of, rollout plan? And within that, if you can talk a bit more about 3.3 million square feet of luxury housing.
So, good morning, Samir. Let me take this. So, the guidance what we've given for the product launch for this year is 7.6 million, of which 0.7 million is what we've actually launched in Q1, right? So, first of all, I would like to say that we are on course to achieve this number, right? And we have a quarterly build-up from now onwards. So, next quarter, again, we have launches adding up to almost 2,000 crores, which are going to hit the market. In Q3, we have close to 2,500 crores of launches, which are likely to hit the market. And the last quarter will be again close to anything 2,000 to 2,500 crore. So in all, it will be almost 8,000 to 8,500 crore of product value, which will be launching during the year, right? And specific to your question on premium luxury housing, which is 3.3 million, this is largely, as Akash talked about, this is floors in DLF 5. Then we have Goa residential, which is going to, yeah, and phase one of sector 63, right? Those are the three which are sitting in this bucket of premium stroke luxury housing.
Yeah, thanks, sir. Very helpful. And the second question is, when we think about the demand outlook in general, what are the risks to it? So its demand is good. It's been good for the last few months across the price point, across locations. So, how long can this continue, and what are the risks to this?
So, Samirji, basically risks. So, I think the risks, frankly, are more macro than micro, really, in that sense. And the macro risks, I mean, when we had met, I mean, I know you were unfortunately not able to attend it, but 6 weeks back, a lot of risks which looked on the interest rate front and macro recession, which still looks slightly farther away, now appear slightly closer. I mean, the Indian demand has so far at least managed to by and large beat it, as you can see not only from us but from all listed developers in this space. But I think clearly, if you're talking about 125 basis points increase more in mortgage rates, with some recessionary trends, I think it will be naive to say that it will have no short-term impact. What we are all hoping is that the impact will be transitionary and it will not have any lasting impact, but a little bit of impact, or say 2 more 50 basis point hikes if they come and the home mortgage rates move to the 8.5-ish range. I'm sure it will have some people will start thinking slightly more before buying into a new product. Be the price buoyancy that generally the industry has witnessed in the last 4 to 6 quarters. Obviously, makes things slightly more costly to buy than what they were 4 quarters back. So I think it's a dynamic position. The fundamentals of the economy and the market remain very solid. The players who are gaining market share and reporting good sales, most of them are in the organized sector, with extremely strong balance sheets, hopefully extremely strong governing mechanisms. So I think the challenges that we had in the early 2010s should not be repeated for a large part of them. But yes, I mean, there will be some headwinds for sure, which I think each player and each geography will have to navigate.
Yeah, thanks. And finally, on DCCDL, a couple of questions. So one is, we are still at 88% occupancy. So how's the pre-leasing environment, and when do you think this goes back to your usual mid-90s? And second is, I know we've talked a fair bit about the REIT formation, but in your mind, in the mind of the two owners, what are the pros and cons, that's sort of keeping you, away so far?
Yeah. So on the vacancy levels at 88%, this includes the vacancy level at our SEZ in Silokhara. and we plan to go back to the mid 90s in the next 4 odd quarters. The one bottleneck that had come about was the SEZs, where the take up by the new units has slowed down quite a lot. However, with the introduction of the new bill, which is Development of Enterprises and Services Hubs Bill, in the monsoon season, we expect the demand in these spaces as the new avatar of IT parks should pick up from Q3 of this financial year. And therefore the occupancies will start coming down. The issue that is being faced today is not that there is no demand. It is just that the business leaders are taking more time to decide the number of new workspaces that they need. Because while hiring is going on in the IT sector at a very good clip, the comeback to office is slower than what they had projected. This is good news and bad news. The bad news is that the decision is taking a little time, but it is showing signs of coming back fairly strongly. The good news is that when we talk to the senior guys in the IT industry, they say that even if it is a hybrid model, the better companies and the captives and GCCs are obviously planning that they will have to cater to the peak requirement of attendance that will take place during the week. And therefore, their requirement of more spaces will be much more. Plus, this de-densification and having more collaborative spaces and spaces where people can interact will also add to that. One or two things, if I may please take the liberty of sharing with you. It's very clear now in the market that the tenants are moving to quality assets. I mean, grade A buildings is passe now. They are moving to grade A plus and A plus plus buildings, which offer a very high level of sustainability, safety, wellness, which have a very strong level of compliance and infrastructure. And equally importantly, opportunities to grow in that area. And therefore, if you see the plan that we have for offices, we are in the three geographic markets where we have opportunities to grow for the next 5 years, 6 years. And these are basically the Gurgaon market, the Chennai market, and the Noida market.
Yeah. And on your question on the REIT, sir, on a slightly lighter, tone. Frankly, we were far clearer on the REIT before the analyst day, when a number of analysts came and confused us, whether we should be doing it or not. Having said that, frankly, sir, I think today, and we have Naveen Kedia, the CFO of the Rentco, who's actually doing the grunt work on that. I think at a stage where if the two shareholders press a button, I think in 6 to 8 months we can get the REIT to the market. I think most of the pre-work is done and behind. Now the key is what is the good time and what is the good intent. So I think the pros and cons, Samirji, better than most of us, frankly, of that given the challenges in terms of the high development potential that Cyber City has, there are obviously inherent differences between this portfolio vis-a-vis the portfolio of the other three listed REITs, which have a higher proportion of the rented assets versus the development assets. And in a REIT format, dividends obviously go up, but then obviously all capexes have to be debt funded. It does inherently increase the leverage in the portfolio, while obviously the LTVs and all will keep on going down. All of those things are there. So I think, and then there's the macro piece where the initial 110 basis points interest rate hike, we had thought does put a slight spanner in the works, but the fact that the listed REITs have actually performed extremely well in the last few weeks, since the entire interest rate hike has happened. In fact, for the first time, all the pundits used to tell us the compressed cap rate has to be GSEC plus 50 to 100 basis points. Abhi the compressed cap rates of the listed REITs are G6 minus, something. So, tayari puri. I mean, I think we are more or less prepared, and in 6 to 8 months, if once the two shareholders press the button, we can go. But I think there are, inherent pros and cons that I think both shareholders do need to consider. And to be fair, I think it's obvious that both shareholders may have, different objectives driving the REIT. The fundamentals of the REIT still stay very strong, including the fact that it gives an opportunity for inorganic expansions as well, in hopefully in a cashless zone. So, but that's where we are. So, most of the pre-work that had to be done, I think, is by and large done. Some clarifications, etc., will keep on coming. But I think we are at a stage where the two shareholders, who are constantly in discussion on this piece, we continue to be, and some of the work streams, including some long cycle work streams like land DDs and all, are underway. So let's see. I mean, watch this space is all that I can say right now.
Thank you very much, sir.
Thank you. The next question is a text question from Biplab Devarma from Antique Stock Broking, and the question is: what are the projects, new phases launched in this quarter?
What are the?
What was launched this quarter in Q1?
So this quarter were the floors, and I'm primarily, if you're talking about the new projects, it was the floors, the new launches, and
a small commercial complex in
small commercial project in Gurgaon, and floors, and then of course there was the other residual of super luxury and OMT. Yeah. So this quarter means floors and commercial.
Thank you. The next question is from the line of Abhinav Sinha from Jefferies. Please go ahead.
Hi. So a couple of follow-ups on what we've discussed so far. So one, on the rental side, when do we see downtown Gurgaon becoming lease income earning? And similarly, what will be the exit run rate for FY23 as well as say FY24, if you can give us some guidance. So that's the first one. The second one is on the DLF DevCo cash flows. So good start to the year, but considering the dividend outflow in 2Q, what are we looking for now for the end of the year? I mean, do we end say below 1,000 crores on net debt? Thank you.
Okay, so the questions on the start of rentals for downtown Gurgaon. I'm pleased to say that we've got the occupation certificate end of June. The process of handover of the spaces to tenants has commenced. Whilst the rental inflow will start from October, I think it will be another few months after that when it comes to its full form. The run rate of the rentals in DT Gurgaon is in the ballpark of 18 to 19 crores a month. In terms of the run rate for DCCDL as a platform, FY24, I mean the exit run rate at FY23 should be about 4,400 crores, and 12 months later it should be about 4,850, 4,900 crores.
Khatter, on FY24, just to be clear, we don't have another building opening up, right, in the next 12 months after we are done with downtown Gurgaon?
Yeah, no, we have downtown Chennai, which is 2.2 million square feet, is going to be finished in the middle of next year. So we believe that the rentals for that will start in the third quarter of FY24.
Okay, and thank you. Sorry, thanks for the clarification. Yeah.
And, sorry, if I may please add, we have had a fairly good run till now where all the new buildings that are coming up, we are successfully able to pre-lease them. And our endeavor is the same for for the downtown Chennai also. Maybe because it's 2.2 million and given the size of the Chennai market, it may be 80% or so. But our endeavor is to see that rentals start immediately after the OC comes in.
And not in the cybersecurity portfolio, but I think by the time fiscal 25 hits us, our joint venture with Hines should also be in a
place where
in a rent readiness mode.
Rent reading, and then on the DLF platform, even the Noida IT Park.
Yes.
By the later part of year, the about 800-900,000 of the data center and the IT park, the first building, should start yielding the rentals.
Okay,
Okay.
and the two retail will also start by that time, right? The phase 5 and the Goa one.
24.
They will start in FY24. Sorry, in the calendar.
FY24?
They will probably go
In calendar
to
24.
of FY25.
Right, right. Okay. Yeah, yeah.
Including,
So on the second one, yeah.
including DLF Avenue in Goa.
Right, right. Yeah, okay. Got it.
Okay.
So on the second one, the DLF, yeah.
Yeah. I'll answer that, Abhinav. First of all, good morning. So our collections, you talked about collections. I briefly answered that the collections will continue to grow quarter on quarter, and you will see that in terms of phasing, second half will be higher compared to the first half, because there are a lot of projects which we have launched in second half of 21, which will be coming towards the end of construction cycle. So there will be corresponding collections happening therefore from that. With regard to quarter two in particular, yes, there will be a dividend outflow during this quarter, but 2/3 of that, as you know, will be funded by DCCDL cash flow. Yeah,
Okay, and sir, in the second, yeah. So on the net basis, see, just to clear up, on the net basis, we had close to 2,000 crores net debt reduction in second half last year, and basically 2Q, 3Q, 4Q combined. Do we see that again?
See, Abhinav, I think we opened with a net debt of 2,600, and you've seen this quarter again, we've dropped our net debt upwards of 400 crores. So right from the beginning, we are not working on a number, to be honest with you, but we are committed to bring it down quarter on quarter, is what I'd say.
Abhinav ji, क्या है कि frankly the net debt number, let's face it, has now meandered into an irrelevant number. But I think a lot of you have it programmed in your muscle memory. So I think free cash flow is the focus that we all focus on, and I think the free cash flow will keep on coming. Fair enough. But net debt हो frankly अब वो 1,000 हो या 1,125 हो या 898 हो, I think it's really meandering into a zone of comparative insignificance from an interest burden standpoint. Sir.
Right, sir. Thank you. Thanks and all the best.
Thank you, Abhinav.
Thank you. The next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi. Good morning. So firstly, just to follow up on the REIT side. So this is the first time in the last few quarters you sounded a bit cautious on the intent to do the REIT. Especially you highlighted the structural differences between the REITs and us. So firstly, wanted to clarify if there is any disagreement between the two partners on the intent to do the REIT.
No, absolutely not.
Sure, because the concern that you highlighted, right, in terms of the ready portion versus under construction. I mean, we knew that from the start, right? So just wanted to understand what could be the deal breakers here.
No. So there are two pieces. You're right. We knew it from the start. We've had a very intense discussion between ourselves, both at DLF and with our partners, on whether we should change the perimeter of the asset portfolio. And finally, we have agreed that we should go with all assets in Cybercity as in, including the entire development potential. Then obviously that does create, as you know, a certain pressure on the financial metrics which the bankers have rightfully highlighted. And I think we're just working on some of those tweaks. As you know, in the current fiscal, the two downtowns in Gurgaon will get completed. 12 months from now, the downtown in Chennai will get completed, and each of these is an important completion, from a rent yielding versus a development portfolio standpoint. So I think both the sides are clear that we need to move in at a time when the macro is most conducive for value maximization. Luckily, neither of us needs to do it for liquidity, frankly, and that is the most important piece. So both of us need to ensure that we do it at a time when actually we can maximize the value of this.
So just to clarify, it's more than the intent, it's more of a timing issue.
It is a timing issue. It is not an intent issue, in that sense, for sure.
So that's helpful. And secondly, we have announced 50% higher dividends for last fiscal. And historically our policy, we've never had a formal policy, but our rather like an informal policy has been that we have always passed on the dividends that we have received from DCCDL as dividends to DLF shareholders. But this year we saw development business scaling up on cash flows as well, which will continue to happen, right? So would we look at formulating a dividend policy just to give some outlook to the shareholders? And also, if you can give us some direction on how should we look at dividends going ahead?
Okay. So right now we will keep the REIT discussion out of the dividend policy because the REIT will dramatically alter the dividend. But assuming that the REIT will take place when it will, our dividend policy is very clear, boss, that you are absolutely correct. For the last few years, it was the cybersecurity dividend which was being distributed. Because let's face it, the DevCo did not have distributable cash flows. It's only now over the last 4 to 6 quarters that the DevCo has begun generating distributable cash flows. And initially, we had the discipline that we wanted to get the net debt under control. And now that Vivek's managed to get that down to almost like a 2000 number, we felt emboldened enough to start declaring a small token 250 crores dividend from the DevCo this year. And hopefully, if the DevCo cash flows continue to strengthen, we are focusing on at least a slight increase, Vivek, correct me if I'm wrong, of the DevCo dividend year on year. On the RentCo side, I think it's pretty clear in the pre-REIT scenario that the free cash flow of the RentCo should be distributed between the the first charge on that free cash flow is of the capex that they need to incur, and the residual piece, part of it goes into dividend. So right now, Cybercity this year has declared a 750 crores dividend, and hopefully that should be sustained, and maybe as more and more properties keep on coming, it will grow. And obviously, once the REIT happens, these dynamics and these numbers change dramatically.
Sure, that's again helpful. And my last question was on earlier in your comments you mentioned that the supply for the industry has started to increase. Any chance that we'll look at upfronting the new launches that we have earmarked for FY22? The 7.6 million square feet that we have outlined. Any chances that we could upfront these launches?
I think last year, if you really look at our total launches was 6 million square feet. This year, it's around 7.8 million square feet, right? So there is an upscaling which has already been considered. Now, if you're saying within the quarters, are we really planning? I think, as you know, that these launches, there is a lead time involved in planning, designing, and approval process. I think at this point in time, whatever plans we have put, we will stick to those plans, and we are committed to really delivering them on time.
Sure. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Sir, just had a follow-up on this cost piece. So, Mr. Tyagi, I heard you said 35% is target, but the issue is as your sales grows, your operating costs will keep increasing. It's unlikely to come down. So I just want to make sure that what is the target EBITDA, or does DLF have a target EBITDA, or just you have a target gross margin range?
So I think Saurabh, as Vivek and I had both, mentioned at the start of the earlier question, we obviously have a target EBITDA, which is the 35% plus level, for sure. Our costs have gone up. I think, and Vivek, you have this nearer to your ears near to the ground. I think the costs have now begun sort of stabilizing now because that one-time ramp up. Please appreciate, Saurabh, 2 years back, we were at 2,500 crore sales with the company with like hardly any new projects, And from that, we have suddenly scaled up new geographies, new product fees, also supporting obviously we get a fees for that, but supporting the Cybercity capex expansions as well, all of those things. So I think our salaries, predominantly salaries, but even the non-salary income have moved up, in that sense. And we feel that I think the rate of growth of the overheads now is more or less plateauing. And what I had said was that the margins will hopefully keep on growing, because the margins that we reported today are of the products which are on the sales levels which are there 3 or 4 years, prior. So I think as the new cycle takes off, and sort of begins catching, hopefully this ratio will keep on improving, frankly.
Yeah.
Great.
Yeah, I think
Sure.
also just for the sake of repetition, I think the new products, what we are really bringing into the market, they are margin accretive, upwards of 50%. I gave you an example of City Floors, 3,000 crore of products which we have launched. They are almost close to a margin of 55%. The one which we are planning in quarter three will be close to 60%. So I think very clearly they are margin accretive. And the other thing, what we are really doing is, when we are beefing up the organization, the reason what we are really working hard is to really make sure that we improve the speed of execution on ground. As we improve the speed of execution, right, it will help us record our revenues. So I think it's a combination of all what we are working, right? Speed of execution will get revenue faster, right? So I'm able to grow my top line faster. My margins are new products, right? The hurdle rate of 50% is really going to make sure that I continue to really replenish at a is at par with my existing margin threshold or even higher. And as Mr. Tyagi said, that the cost base has been reset, and I think that's not really going to really keep growing from here, right? So therefore, hopefully, all this will really result, right, in the near future, where we will surely hit the EBITDA of 35% and continue to really improve thereafter.
I hear you, Vivek, but if you look at your slide 9 and 10 of the presentation, the new project gross margin, you claim 1,800 crores of gross margin against sales of 4,600 crores on page 10. The gross works out to nearly, more like 40%, not the 50% mark. So I'm sorry to belabor this point, but so what is giving you the confidence that this number kind of gets sustained?
Saurabh, I can separately share the details,
Yeah.
product wise,
Okay.
right?
That'll
But
be
I think, as I gave you a big example, right? Out of the total 4,400 crore of launches, what we've really done, say in the past couple of quarters, I gave you one example. The biggest product, right, which is floors, is at a 55% margin, which is almost 3,000 crore, almost 65% of that. But I'm happy to share details offline.
Okay, and just one follow-up question, sir. Historically in 2012 to 14, we used to have huge cost escalations, versus what the budgeted numbers were. Is there anything you have done in this cycle to make sure, because inflation is hitting, so basically to manage your budgets better in terms of, and what's the like-to-like cost increases you've seen in the portfolio versus the January start to today? Thank you. And that'll be the last question. Thank you.
You'll have to maybe repeat what you just said.
So basically, historically, we have seen in DLF, the cost escalations have been very massive, at least in the last decade. So this time around, have you done something better to basically ensure that the cost escalations don't hit you? Because we're now again entering an inflationary period. And,
Okay.
And the second is basically, what's the like-to-like cost increase you've seen versus budgeted to today? What's been the experience in the last 6 months?
Okay, understood. So I think on the fixed cost, I think Saurabh, I think we've been very clear on our guidance. So, and I think we gave a guidance when our business was 4,000 crore. Again, I outlined my guidance on fixed costs when we are scaling up to 8,000 crore. I think let me move to the construction cost. I think that's where I think your bulk of the question is. And I think one of the learnings, I think what we have really applied is to really very closely monitor the construction cost. So just to let you know that we, at this point in time, we have more than 35 live projects on ground, and we make construction budgets every month. So there is a review which happens every month in terms of how the construction cost is really moving. And so for all the projects which are live and for all the projects which are there in the pipeline, and that gives us early warning in terms of really positioning our pricing for that product, right? So I think that's something which is really embedded in our business. Like I said, the margin hurdle rate, that's very, very part of the project budget discussion, what we really do. There is a very high focus on cash. So while there is a hurdle rate for margin, there is a hurdle rate for cash, and the construction budget reviews what we do on a monthly basis clearly keeps us very close to the ground reality in terms of how the inflation is moving. Yeah.
The one mistake that we did in the 2012-14, since I am a survivor of that period as well, and which we are not repeating now, and which sort of ties into some of the questions raised in the call on upfronting of launches, etc., is that at least definitely on the high rises, we are definitely not going to launch anything till all of our contracts are in place, designs are done, and the good for construction drawings issued. Actually, frankly, and sort of, I mean, since it's 8 years and time, and now the discussion is technically time barred, the fact is that a large part of the hits that we got that time were partially on account of inflation, but partially on account of the fact that we had maybe launched those products prior to doing a detailed cost estimation of where we were. I think that mistake is definitely not happening. Obviously, the inflation on commodities and all, as Vivek explained at length in the last quarterly call, has taken a toll. But the good news is there are no surprises that are happening. So, like, I mean, every quarter, almost every month, even if a project cost goes up by 1 crore 25 lakhs, the business leaders, Devendra Singh or Vishal Damani, I mean, they are on top of it, RK, and then everybody knows that 1.5 crore बढ़ गया है in that sense. So at least the surprise element is not there. I mean, but yes, I mean, obviously we can't control the macro inflation, but that is the way. And this, I don't think this discipline we necessarily had in the 2012 to 14 period.
In fact, if I were to also add, we are also further strengthening our project management process. And one of the things we are really doing is that this whole project management, which a large part of it we do outside ERP, we are planning to really bring it into ERP so that we can really closely monitor the execution of the project, the planning of the project, the cost escalations, right? As we are scaling up, we are really getting ready how to really handle the scale as we go forward.
One thing that I'd like to add to your point, Saurabh, which I feel we never get any marks for, is obviously one is the inflation and all the other finance-related matters, which is we can't take away from it because it's business. The other thing I think our biggest thing is that we continue to improvise, and to the point that you mentioned, we, irrespective of what our financial commitments have been to our investors, we have gone back and bettered the product in its life cycle. So if you ask me, I think that is something that we have continuously done. We can't take that out of our DNA. Those projects have never gone back and given us more money, but definitely they have done wonderfully well for our investors. You look at it from any point of view, and all those products we have gone back and then gone back to making them better, and so that both from the point of view of the product and from the point of view of what the actual investment returns for our investors are. Investors, I continue to say that, not to us. We may have lost money, but I think that is something that we are hopefully changing. I don't know. I mean, financially, yes, everything, but I think to continue to better ourselves every day and to keep the aspirations going, I think that is something that I think it's more of a, I'd say, you really can't put a finger to it, but that is something that I feel collectively has helped keep the DLF brand goodwill, on top and continue to make us aspirational. And we've done it on our account, So I think that is one thing also probably, I don't know whether we can still change, but I think there's a hell of a lot of discipline as Vivek just mentioned and Mr. Tyagi every month, and also to add to what Vivek said, that every time there is a 1.5 crore increase somewhere, it's passed on to me too. So I understand the pain more than any one of you. So trust me. Thank you, Saurabh.
Good to hear that.
So-
Thank you, guys.
Saurabh and our other analyst friends, if I may take the liberty of adding, I would request you to please go through slide number 26, which again, what Akash was mentioning are some of the softer issues which probably don't get highlighted when we are talking of numbers all the time, is that in terms of safety and sustainability, we've taken a leadership position across the globe now. And we have one of the world's largest US Green Business Council LEED Platinum certified portfolio. We have the largest portfolio in LEED Platinum Zero, which is in the area of water, which is again the largest portfolio in the world. And recently, we have got the LEED Platinum for the cities and communities for DLF Cyber City Gurgaon. You guys, most of you have visited it. You know that it's whilst it is a cyber city, it's not a gated community and it is open right across and it's really like a small city. And we are the first developer-owned community in the world which has got this platinum rating. And I think as we go forward, these steps that we take in the area of safety and sustainability help us position our products in a better way and also contribute to what is now become important in terms of sustainability and carbon neutrality.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Ashok Tyagi for closing comments.
So again, thank you all of you for taking your time on this Saturday and joining us for this call. We could have waited for till Monday, but we rightfully felt that we should do it, the day after the results. As you know, I mean, the results, as Vivek and everybody has explained to you, have been reasonably robust, and I think we are looking at a good year, hopefully. I mean, the current year could have some more macro headwinds as we outlined than the previous year had, but I think clearly I think our basics are now falling into place. The Rentco piece is actually now performing far better than what it was 12 months back when we were at the peak of COVID. The vacancy levels are dropping, new capexes are back in play, retail has had a dramatic turnaround. And I think hopefully as we keep on reconnecting back with you every quarter, we will keep you abreast of all the new developments that are happening, including the new launches. And hopefully you continue to enjoy your support. Thank you.
Thank you.
Thank you. On behalf of DLF Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.